You're watching SBA Today. With all the latest news, stories, and advice, here are your hosts, Paul Long and Tonya Mazurek.
And welcome to SBA Today, sponsored by SBA Collective for the week of February 16th. I am Paul.
And I am Tonya. And today we have got a special guest, David Parrish. David is a wealth of knowledge. He's secondary market investment expert nowadays. And believe me, he totally is. And recently separated from the role of manager, secondary market group, Office of Capital Access at the SBA, guys. So
this is going to be a treat. Welcome, David. But first, tell us a little more about you. That's what you did. What do you do now?
Sure. Good morning, everyone. Good morning, Paul and Tonya. As you all introduced me, I'm David Parrish. I was a 20-year veteran of SBA, and last spring, I opted into deferred resignation and early retirement. And for the first several months after my departure, I basically cooled my jets and took care of a lot of personal goals and some tasks around the house and networking with a lot of people until my deferred resignation contract expired. And since October, I've been officially retired, which is still very odd to say. And in November, I had a colleague, a good friend of mine, a mentor, who ran an SBLC or runs an SBLC at this time, and approached me and basically asked me to start up a business so that I could consult with a buyer who's interested in acquiring the SBLC license of my friend whose parent company wants to exit the market. So, at that behest, that was basically too good an offer to pass up, and something that I really wanted to try and dip my toe in the water. So they became, they're based in the Rocky Mountain region, it became my anchor client. And since then, I have been working with several other lender clients, as well as a few small businesses who are not very familiar with SBA products and how to make approach to lenders and to access the SBA ecosystem, and taking them on in a consultant role to help them enter this world, this community, to introduce them to people and to smooth the way in terms of their access to capital and realizing their dreams. And the clients I'm working with are looking at acquiring existing businesses.
Interesting. Awesome. Well, first of all, thank you for your 20 years of service at the SBA. That is a long time, and I definitely appreciate that.
Yeah.
Well, now that we have this beautiful brain on our podcast, what are we going to talk about? This is good.
For me, you're talking. No.
That's right. That's right. The next question is
about you.
Yeah. We all know, right? Okay. All right. So first up today, there is some big news out there. You all know in our world, right? What's going on here? The procedural notice to permit alternative base rates. Now, this is really interesting. Hello. Beginning on March 1st, 2026, SBA will permit lenders to use SOFR, 5-year Treasury, and 10-year Treasury for variable rate 7A loans. And just so everyone is clear, today's rates for prime are 6.75%. The SBA optional PEG rate is 5.75%. The SOFR rate is 3.68%. 5-year Treasury, 3.78%. And the 10-year Treasury, 4.21%. So they're all over the board a bit, right? Yeah. So that's kind of a different little thing that we got going on. What do you guys think about that?
Well, before you get into this, David, I have to make one comment here. Okay, so when this came out, that I've heard everyone from SBA, "Ooh, I'm excited for this. I'm excited for this." I talked to a bunch of SBA managers, and they're like, right. And I'll be honest, I'm kind of the same way. Like, why should I be excited about this?
Great question. And I think it is the question. Hearing those comments, and Paul, having you share your observations about your conversations with SBA staff, it reminds me of a Super Bowl ad recently that came out during the game where everyone it was the concept of meh, MEA. I'm worried about this. This is kind of meh. Well, on the surface, this is a very, bit of a meh concept. But let's put it in context and provide a little history and then draw a line in the secondary market between the borrower and the ultimate end user here. So first, the base rates. Prime and SBA optional peg were our two foundational base rates. They've been around a long, long time. And the optional peg rate is actually a weighted average of several treasury rates. That's how that peg rate is derived. It's not picked out of the sky. It's a calculated number. It's updated quarterly. And it's not used real often, but it is out there as a base, as an acceptable base rate that provides a lot of stability because of its weighting. You know, when you take an average doesn't move a lot unless the components of the average move a lot. If you have one component really skew, the average is not going to move. We all math classes in school. That's the logic behind the peg rate, but it was never really adopted in widespread use. Prime was always the anchor rate. It's the one in America. And now, what did we have before? For SBA veterans, we know we had LIBOR as an acceptable base rate. That sunset a couple years ago. Well, LIBOR is an acronym, just like SOFR is. We'll get to that in a second. LIBOR was the London Interbank Borrowing Rate. And it was established not by the government of the UK, not by the Federal Reserve, but it was an agreed upon overnight interest rate that was decided by some of the largest banks that were headquartered in London many, many years ago. So it was essentially a cartel rate. All right. This is, going down a big that we had no control over it as U.S. financier. U.S. government had no control over it. It was brought in during the credit crisis when the American government were forced to take prime down to zero to restart the lending system. And U.S. lenders said, well, to perform SBA borrowing when a base rate is 0 plus spread. Where is this going?
Sure.
And so LIBOR was brought in. It was sunset. We had to do something for a while. The SBA philosophy, I watched the sunset period, was, hey, we are not on a time constraint to introduce another rate. SOFR was examined. SOFR is the secured overnight funding rate that is controlled by the New York Fed. It's published every morning at 8 a.m. Eastern time. So it's under the government's control. It's here in the U.S. It's published reliably. It's open source. It's not behind a paywall. It's very transparent in that regard. And in the last 5 years, it really hasn't moved that much. And so for all those reasons, SBA decided to introduce it as an alternative base rate in the Working Capital Pilot Program. The Working Capital Pilot Program took off a couple of years ago, and it has been, I would consider it fairly successful in people's adoption of it. It's certainly used more often than the Export Working Capital Program. And it's nice. We need this. We need a revolver in our portfolio of products. And it was used, and the success was seen. And even at the time that I exited SBA, it was being considered as rolling it out to the larger 78504 world. So I'm not surprised by that. The introduction of the 5 and 10-year treasury rates as a base is a little bit of a surprise to me personally. It wasn't being discussed when I was going out the door last spring. However, I think it provides some additional alternative and stability when prime moves drastically meaning a quarter point, a half a point or more. Sure. And we don't know when those times are going to come. We just don't. And it's I think looking at this and trying to read between the lines, I think SBA is getting ahead of the curve and ahead of a big market correction by having these rates available rather than having to come up with a solution in a time of crisis.
Well, let me ask this, because as a lender that sells on the secondary market, are all of these base rates going to be eligible to be sold in the secondary market? If I do a 5-year treasury plus 10-year, 25-year loan, can I sell that on the secondary market?
Short answer is yes. The longer answer is you can sell it. It is eligible. And then the buy side has certain requirements on them. Broker dealers, pool assemblers who are buying your loans can only pool those loans in like base rates. So prime based loans are pooled in prime loans. And SOFR based loans will be in SOFR pools, and so on and so forth. And SBA rules for pool assemblers require, there are two different kinds of pools. Standard pool, which is what most pools are created, requires a minimum of 10 loans. That's not tremendous volume. Okay.
No.
And a weighted average capital pool, a WAC pool, as the acronym is, it only requires 5 loans to pool. So in terms of critical mass, the bar is set intentionally low to allow people to form pools with these base rates that are very common and also ones that are uncommon, so that the market stays liquid.
So, okay, so I'm so sorry, Tonya, but
Okay.
this is so fascinating because another thing is, okay, I would think that the premiums on SOFR, 5-year Treasury, 10-year Treasury will be less than prime. Is that a safe assumption? Because there's less volatility, which I would think that the secondary market would want a little bit more. Does that make sense?
Yes.
Or
yes,
do you
you're
think
on the
they're
right
going
track.
to be the same in premium?
You're on the right track with that being a consideration, Paul. The
Okay.
variability of the rate is a consideration. The spread from the base is also a consideration. Right. And there's a little variance there. We know that not every loan is maxed at the base rate plus the maximum allowable spread, that people do compete on that margin, as well as the default rate. So all of those, or what really secondary buyers are more worried about is a more general term called the purchase rate.
Right.
Encompass both refinance and taking that loan out of a pool, out of the secondary market, as well as an actual default. They're the same to the secondary market because it's being withdrawn from the market, whether it's withdrawn from duress or withdrawn from financial engineering, the cause is irrelevant. So those three really are the variables that go into the premium calculation sauce that each of the broker dealers develops as a purchase model.
That's super helpful. I appreciate you kind of diving into that, because that there's so many different moving parts in the secondary market, and as
pricing is alchemy.
Fellow nerd, that when it comes to this, I just love to understand that. So I'll shut up.
Pricing is subjective. It's 80% objective. It's math. It's discounted cash flow analysis.
Right. Sure.
But then there's that 20% of variability where it depends on each broker dealer's preferences and their buying tolerances and their cost of capital.
Got it. Well, I had more, but I think we'll move on to the next subject right now. Otherwise, we can go down a very long rabbit hole on that one.
Yes, we could.
But yeah, Paul, what do we have next?
So let's shift gears then to the SBA 2025 annual report that came out.
Yes.
SBA reduced headcount by 53%. You would know anything about that. Using voluntary early retirement or deferred resignation. What is your take on that subject? And is there potentially more to the story from your perspective, having being one that's obviously taken that retirement package?
Sure. So as I mentioned, I'm a 20-year veteran of SBA. I came in 2005. And so I have the privilege of having seen several administrations and several handoffs, several different styles of leadership with many different priorities. And the 2020 to 2024 period, a large priority was staffing up and increasing headcount, primarily to address the demand on PPP and disaster on idle programs.
Right.
We brought in a lot of people, a lot of contractors, and that headcount was very slow to be reduced or to be decreased and shrunk at the end of COVID as we were coming out of that period. And I think looking at what has transpired over the last year, the administration put a priority on reducing headcount and reducing overhead costs of the agency, which totally legitimate, makes a lot of sense when you're looking at it from a corporate standpoint. It was done in a very expedient manner. I will say I was given, I think, a week or 2 weeks to make my decision, and deferred resignation was a component of it. Voluntary early retirement was another. The only way that really mattered as a 20-year veteran to me that made sense was to couple the two. A lot of people opted for that. So we ended, there's a big cadre of us that came out who had a lot of experiential knowledge and decided to make our way into our second career or to retire permanently if they were in that age bracket. The 53% headcount reduction was a little surprising to me. I didn't know what the absolute number was. And within that reduction, cutting staff by half, I don't know what the split is between people who were hired in the last 4 years since 20, I would call them the newbies, and people who were the veterans, had more than 5 years of experience.
Well, and with that, what I would say with that too is there's a couple of things actually that I caught within that, right? So they upped the amount of people in SBA and people that they brought in from past the 2020, COVID era and whatnot, right? So they increased how many employees they had in the SBA, and then they just did a 53% reduction. Now, how much was increased prior? So is that like taking it down less than pre-COVID era, or is it just taking it back to where it was?
Yes, great question. I think from reading the annual report, that section, that staffing levels are now at or about pre-COVID levels.
Okay.
That may be, 50 to 100 people, 150 people variance, but very, very close to where we were agency-wide prior to COVID.
So then with that, I'm going to go further on that one, right?
Sure.
Because then with that, as you kind of, touched on a little bit there, right? How many were actual employees prior to the COVID era, and how many were hired on due to it, which is kind of what you got to there with the level of experience, maybe that either stayed on and or left due to.
Right. Hard to tell. You can't tell from the annual report, and I've not been able to really draw a lot of detail out of that from my friends that are still in the agency. I don't know if we'll ever get a real answer to that. Maybe you'll hear it in a committee report, something like that, coming, Senate or House side. Maybe someone will ask that detail. I think it's really interesting because it speaks to a couple of concerns that borrowers and lenders have or ought to have. The level of service that SBA is able to provide as an agency, response times to questions, to resolution of, let's say, challenges. Like maybe you have an outstanding PPP loan, you have an outstanding EIDL loan, you want to get some details on your 7A, and you need some resolution on that. You all know from the and also going forward, what's going to be the product portfolio that's offered by SBA with this headcount reduction? Is anything on the board for a drastic, like paring down or a possible elimination? I've not heard anything.
Go ahead.
I've not heard anything.
Cap line.
I think the portfolio will largely stay intact, and I hope so, because there's a lot of great products there, and a lot of the anchor products are doing just fine.
So I want to just for those that are listening that maybe aren't in SBA or don't really understand how this works per se, as far as what it could mean if experienced left versus inexperienced left, right? I mean, you can liken it to being a lender, let's say, and you make a move to another bank, and previously you knew exactly who to go to for everything that you were doing. You knew how to get around some of the internal challenges. You knew tricks. You had seen things over the years that had come to you. You had colleagues that you guys could back and forth go to. I mean, this is kind of bigger than just experience as far as training knowledge up front. We can all get the training knowledge. It's all those nuances that go underneath that training of just the product itself that creates a slowness. I know I moved institutions last year. It takes a second to figure out how to maneuver around a new place and the rules within and whom to go to and all that. So, for any that aren't really picking up on some of the nuances of how, the experience versus the inexperienced, let's just say, and I hate that word, but meaning the tenured versus the untenured, right?
Yeah.
That's kind of what I'm thinking about.
Oh, I think you hit on a great point. Knowledge is sitting in class or going through a training program or a development program to be capable and competent in your position. Wisdom is the application of that knowledge. And I think there is an elevated risk. There is some risk and some concern how much knowledge walked out the door with this big pare down in the staffing levels.
100%. I mean, if somebody calls Paul or I as a lender in the SBA that's been in this for a long time, we've seen a lot. I mean, right? We've had a lot of interesting things that's come through or across our desk. Whereas somebody brand spanking new as a lender in the SBA, they might know the SOP. They might know eligibility. They might know what their bank does or doesn't do. The nuance, though, of listening to someone or recognizing other ways to get through a challenge because you've seen it work, that only comes with experience.
That's right.
When I see on the email, comma, or it's comma contractor or parentheses contractor, I'll always roll my eyes. I'm like, oh, okay, I'm going to have to tell them how to spell SBA.
Yes. It's a concern. It is a legitimate concern of the agency. But as we know here, the three of us here know that the SBA ecosystem definitely must address succession planning within the workforce. Attracting new talent, attracting people, out of high school, sometimes out of college, from early experience careers in lending and other aspects of lending, and introducing them to SBA lending and getting them on that learning curve as soon as possible. I mean, the experienced people who are working now, who are reliable and credible and considered the voices of the industry, are, we're all working toward the finish line.
Yeah. And
the best thing we can do is to begin very early, passing that knowledge down and not being selfish about it. There's in my opinion, there's not much to be gained by being selfish.
What I would also say to that is there's also something about those newly coming in and what they can bring to the table. It's kind of like, it's kind of like you've got your elderly grandparents that have so much knowledge, it's ridiculous, right? But then you've got your kids. And if you listen to those kids, they've got things that you never would have thought of because they're coming through it in a different time frame, in a different decade, in a different. So there's so much that can be garnered between both. If those who've been in it for a minute are willing to instill their knowledge of what they've learned through the process. And then those that are younger, are willing to listen, but also are willing to step up to the table and say, listen, how about we try this? This could work. I think that's where there could be, a wealth of information that explodes out when it comes to both together. So anyway. I don't ever want to leave out those coming in because, man, we need it. There's people retiring out, as we know, and so we do need people coming back in as well. But okay, well, let's go ahead and go to the next subject so that we've got some time for it. And what this is SBA 7A and 504 year-to-date loan volume as of February 13th, 2026. So 7A volume is 18,400 loans for $10.2 billion. And then the 504 program volume is 1,700 loans for $2 billion. Now, David, in hearing those numbers, how do you see fiscal year 26 looking comparative to fiscal year 2025? And do you think the Mark Working Capital Program, Made in America Finance Act, or the possible increase of the manufacturing loans to 10 million will have an impact this year? Thoughts?
Yeah. Right. Two ways to look at this: year on year, apples to apples. If you take all the changes out, how is this year looking compared to last year with the 5-week shutdown? Lenders weren't shut down. SBA was shut down. There was a backlog. I think it has worked its way out of the system, which is great. It looks to be about even in that regard. Now, what's going to add to the growth of the program? The manufacturing working capital initiative, the increase in the 7A program for manufacturing loans to 10 million. We don't know just how big an impact that is going to have. I think a lot of lenders are doing a lot of homework and dedicating a lot of resources to identify potential borrowers in that bracket, and also working to improve or to revise their underwriting processes to be able to take on a loan of that size. A lot of boxes in SBA were built a long time ago for the 5-year limit, and going to 10-year is getting, I would say, progressively nearer to asset-based lending and needing a lot higher level of monitoring. So that's and that's cost, right? But also there is some upside to it. There's some money in it. On the downside, I will say, or on the potential risk or challenge side, is the recent procedural change to prohibit legal permanent residents from being owners in applicants of lending. So this is going to be a little bit of a minus. I don't know how big a minus. So we've got 2 pluses and a minus if we're doing a quick T accounting of changes. And so I think it's really out right now. We're in February. If we look at this in April and May, I think we'll get a really good idea of how much traction the manufacturing initiatives are getting and what kind of impact the restriction of legal permanent residence is having.
So it might be longer than that.
It may be. It may be. I think my guess, if I were putting one high or low, I think it's going to be probably an even year. We had a considerable amount of growth between 24 and 25. I think if we held our own, collectively as an SBA world, in terms of 504 and 7A volume, that should be considered a win.
And I would think that the permanent resident alien thing is going to affect us for sure.
Yes.
That again, I mean, my crystal ball says 20 to 30%. That's what I'm thinking.
Really?
But what
wait, go back to that, Paul. 20 to 30%. You think it's going to drop by 20 to 30%?
I think you are going to see a massive amount of less loans coming through. Right now, we're seeing a big, huge, massive trying to get these loans done by March 1st. I've already heard through multiple other cases that department, the Sacramento 504 email box, is backed up. And to be honest, if you haven't submitted yours last week, you have a 0% chance of getting it approved. So I just think that there's a lot of pressure right now, and then we'll start to see the effects coming up in March. But I do think there will be a delay. I mean, there's institutions that focus on this. Well, they got to completely change their business model. There's a lot of areas across our country that have a lot of different, potpourri of individuals. A question that I have for you is, in my opinion, sorry, I'm going to get a little negative. The MARC program sounded good, but I know the results are not that great. What do you think the real cause of the MARC results? And then I want to get into one of the comments that somebody dropped as well after that. So go ahead, David. Manufacturing. I was at a one-day secondary market summit in December, hosted by one of our mutual friends, Bob Coleman. Great time to get together. We had some SBA people there from Office of Capital Access, and we spoke to them, and we spoke amongst ourselves in a later breakout session about this product and its relative benefit. That we know that it was everyone on the lender side who was attending, as well as the buy side. The buyers don't have any problem taking this size loan into the market. There's a little bit of indigestion about, we've seen some of a $5 million loan, 3.75 is the guaranteed interest at 75%. So you're talking about doubling that to $7.5 million. That poses concentration risks in smaller pools. We talked earlier about the pooling. So there's some talk on the secondary market about asking SBA to allow what's called the fractionalization of that guaranteed interest, like splitting that 7.5 into two 3.75s in order to stack it in pools and lower the concentration risk in the pool a little bit.
That's a relatively light lift. We don't need to get into the rule making changes there, but it's a reasonable ask, I think. And I think it's under consideration right now because it's a smart move in the long term. I think that it is difficult to quantify the statistics I saw in previous years before this raising of the limit. About 10% of SBA dollar volume year by year was attributed to manufacturing NAICS codes, manufacturing industry codes.
I'm sorry, you said 10%?
10 to 11%. So, not the biggest concentration, however significant. 10%. Anytime you get into double digits, that's significant.
For sure.
And so I think it'll go up because of the dollar amount. I don't know that the number of transactions will change on a percentage basis nearly as much as the dollar value change.
Right.
Interesting.
Oh,
what was the
okay,
question?
so let's see. We've got Jorge Machado says the minus will be much higher than the plus sides, specifically in Florida with respect to eliminating permanent visa holders. I agree the loan volume would drop, especially in Florida, and feels like we'll see the same drop in California.
So if we look at demographics, Jorge makes a good point. Let's look at the four big markets in the SBA lending world: California, Texas, Florida, and New York. These four states have large populations, number one. And within those populations, so they have large SBA lending volumes, but within them, they have relatively large legal permanent resident populations relative to the other 46 states. And so, I think Jorge's onto something that we're going to feel it in those big markets, that it is going to move the needle. I just don't know. The wild card is how much manufacturing lending is going to take off.
Got it.
But yes,
interesting.
The striking down of legal permanent residence is a big change. And for me, statistically, from the data and like analytics side on secondary, or even on when I was an examiner of SBLCs, we never really looked at what percentage of a lender's portfolio could be attributed to ownership structures that incorporated a non-citizen. That was just not something we tracked. And so when I saw that change, it kind of threw me for a curveball because I couldn't go into my memory banks of reports or analysis that I'd ever performed where that was a metric of consideration.
Right.
So I'm a little bit in the dark about the impact. I'll take Jorge's word for it. He's obviously working, I think, in the Florida market. He knows his community of borrowers, and he knows, I think, probably has a really good ballpark idea of how many of them are in this pool of people that are, as of March 1, are going to be prohibited from accessing the program. And remember that I want to make a point too, like existing borrowers that have ownership structures that incorporate legal permanent residence, those deals will stay in place. It is the applicant. An applicant doesn't become a borrower until they're approved. It's kind of a semantics exercise in the SBA world. But I'm with Paul. Like if your application's not in, if you're looking to the processing centers for approval, PLP lenders who can process and approve with debt authority are going to be able to expedite these here in the second half of the month. And they have a little bit of an advantage over those that go to the processing centers.
Well, a question for
that.
A question for that is what's going to happen? Like these things close and you get down the line and there's a servicing action, or, you need to go back for modification, or you got to do something past.
And if you want an answer to that, stay tuned for next week where that will be one of our topics.
That's great.
Because I have answers.
Oh, he's ahead of me. See, again, y'all, I tell you, he does this to me.
That's a great subject to think about.
Yeah. All right. So then we've got another question here. Jeff Gerling, curious to know what % of SBA loans involved the legal permanent residence in 2025. Of SBA loans involve legal permanent residence in 2025.
Well, that's what you were just saying.
I'm curious too. I'm very curious.
I think
if somebody knows, y'all go ahead and put it in the show notes, man. Put it out there.
I think it's going to be a scary number, and that's why it hasn't came out yet.
SBA's site has some Freedom of Information Act, like monthly reports they put out on lending volume, and they're just gigantic data files to download. A good data nerd will down and see if there is a category that attributes foreign ownership or non-citizen ownership. I don't think just remembering, doing a lot of this work and using a lot of those data sets that is a column, but I'm going to go back and double check. And if so, I'll write you a supplemental note and send to you all later so that we can have that little trivia fact.
We'll drag your butt back on here.
There we go. It's interesting, though. It really impacts a lot of things. And, the ownership threshold was already set very low as far as, how much non-citizen ownership could be incorporated into a deal. But we've eliminated that. I see the pluses and minuses of it. And I also want to I want to bring out a phrase that I heard: nothing is ever as good or bad as it looks. The upside's never quite as bright. The downside's never quite as gloomy. And this decision is a decision that is not a burned bridge. It can be recrossed if the impact is so adverse that policy developers and policy decision makers in DC determine that it needs to be walked back. So
I would love to know what the reasoning was to put it into place anyway, because nobody ever knows. None of us knows. Shush. Nobody ever knows what the reasoning is behind some changes that are made. Now, I like to believe that there's reasons, and there's always reasons that I don't know, good and bad, right?
Yes.
I don't know what creates certain policy. I don't know what creates things that I might not agree with up front, but might actually have a reason that I'm just unfamiliar with. That needs to happen. I don't know, right? And so I try to look at it from the standpoint of what could be the reasoning behind it. There has to be something,
yes,
right, that none of us maybe
it wasn't
know.
pulled out of a hat. I mean, there's the deliberation process in SBA to change procedure, to change rules is lengthy, and it's deep, and it incorporates a lot of different offices, which is great, because it reduces and a lot of times eliminates blind spots, unintended consequences. And I'll say, just as an observation, that this change came around the time or on the heels of some other announcements made by SBA. And one of the big announcements was the identification of a rather significant volume of ones that are already on book that are suspected to be potentially fraudulent or something that have been taken out or approved by borrowers who might not be acting in the best interests of the SBA according to the guidelines, lending guidelines. And so there may be some correlation of that, but again, that's pure speculation.
Well, all we can do is speculate because we don't really know, right? And
that's right.
But in that speculation, I mean, that's across the board. I've seen this so many times, and I might get my butt burned up front, right? Where I'm like, I don't agree.
Mm-hmm.
But then things come out or trickle out over time of what the reasoning was behind it, that sometimes then comes back and it's like, okay. And it doesn't, and it has nothing to do. This rule change is hurting people right now. I mean, that's just how it is, right? It's hurting people, specifically those that are in process, that have spent money, that thought it was going a certain direction, and now it isn't, right? It is hurting people. And that's challenging to be a part of, right? But that is what that is. And the other thing I've often seen is because others have acted in such a way that has hurt a system or has hurt a process or a program, rules are changed based on the few potentially.
Yes.
That hurts a very large group. I mean, we see it all the time. And I just wonder if this is potentially that, where they're tightening the reins in a certain area because there's things we don't know that are challenged, but it doesn't mean everybody. It means certain ones.
Yes. You're
They're the
exactly
ones
right.
that are creating everybody in a portion or a part, or that's getting hurt.
Oh, yes. When you set a general rule based on exceptional observation in the statistics, I mean, it's not a great rule, right? You're trying to correct for, something under a 1% or 2% deviation, and the 98% are well within the existing guardrails.
Right.
And so you make a rule to address the 2% rather than simply enforcing the existing rules on that 2%.
Right.
That was something, as in 20 years of experience, different offices within SBA. Yes, this is part of the policy development and policy rulemaking process, is trying to stay away from that, like overcorrecting, if you will. And it's tough. It really is tough. I think on the other side, pointing out, just drawing this subject to get together with the previous one we talked about, the headcount reduction, knowing that there's been significant headcount reduction in the corporate world in the last year, several 100,000 layoffs, in addition to the federal government, not just SBA, but all the offices. There is an ocean of people who are in career transition, who are now, like myself, future potential small business owners. Couple that with what they call the Great Transition or the Great Migration, which is the end of the boomers and early Generation X, who are now retiring as small business owners and looking to sell their business, because that is the anchor of their personal wealth at this point. They built up a pool business. They built up a construction business. They built up a restaurant. These two dynamics are colliding now. These two fronts, the experienced labor that's been downsized out of the corporate and the government world, and also retirees, people who are retirement eligible, who have great small businesses all over America with existing customers that doesn't require all the energy that we know startups require. Like, to me, that is a recipe for replacing some of this volume that we know is going to be short-term.
Right.
This was fun.
And and just for you guys out there that are going through this, we're not calling you volume. Just so you know, that wasn't the intent. I think what the point being, it is creating a softening, or there's going to be a lot less that go through that previously had LPRs associated. We are not in any way downplaying that, because we know exactly the pain, and well, I don't know it. I'm not in it. I'm not trying to get a business, and that's not mine. So I don't want to put it out there in that way, but recognize that there is a pain to it, and there is a challenge because of it. And I can't even imagine the thoughts behind it. However, what we are saying is, oftentimes these things come in such a way, like here it is, Jorge's saying, Machado, LOL, at the end of December, the SBA walked back its rule to allow up to 5% foreign national ownership. Then 30 days later, they walk it back again with only citizens. Seem to move fast, not slow. I feel like things have been a wee bit up and down and all over the board in general since the unprecedented COVID days, right? So for me, in this industry, across the board, left and right, up, down, nobody knows what's coming from 1 minute to the next. It seems like it has been going on for the last 6 years. Anybody else? What do you think?
Oh, yes. Since 2020, yes. I remember the days, 7 days a week with you two working, my side of it from SBA during PPP, and seeing people, and then coming out of it and trying to find our footing again. Where are we going in the next chapter, to where we are today, and see some changes. There's a couple of observations to make. Number one, this world of small business lending is incredibly resilient, incredibly adaptive. The professionals at lending institution, the patient borrowers, we just keep coming back. We just, it's just, we get kicked from one side of the road to the other, and we come back for more. And that's fine. I think that's part of our American DNA, and this system. We're kind of like water. We flow to the opening, and we will find an opening in this situation.
And guys, we need the SBA. Just FYI, we need the SBA.
That's
And if the
that's a
program
gimme.
goes away because we don't have money and it's no longer self-supporting and it gets voted out or whatever the heck could happen, right? We need the SBA. So many of these changes, I believe the intent behind them is for long-term keeping the SBA a viable program.
Absolutely.
So
Absolutely.
I'm going to say that. All right. Well, we are way over our typical. Way over. Yeah. Anyway, we are here on Tuesday mornings live on LinkedIn and or YouTube. Otherwise, any of the streaming platforms where you get your podcasts. Follow Paul or I on our LinkedIn pages. Connect. Ask questions. Thank you this morning for all those that did ask questions. We love to hear it. Go look at any of our past episodes and or our sister program, the BDO Show. And other than that, we will see you next Tuesday morning. David, thank you so much for coming on.
Thank you.
Go check out David Parrish. Yeah.
Thanks.
Thanks,
It was
guys.
great to be here with you. Thanks so much for the opportunity.
Absolutely. All right. We'll see you all next week.
See you later.
Okay. Bye.